I wanted to thank everybody for joining us for our first annual Insurance Day at Denton's. So thank you all for coming. My name is Lori Lapalme. I'm the Global Sector Lead for Insurance, and I am also the Co-National Lead for Insurance of Canada. On behalf of the Insurance Denton's team, I wanted to thank you all for coming and thank all our distinguished guests and speakers who are going to be talking about the most pressing issues and emerging opportunities that we're facing in insurance in Canada. So as we look forward to 2025, there are several key trends that we are looking at. We are going to be exploring enhanced oversight of artificial intelligence. We know that AI is disrupting the insurance industry like other industries, and what's happening and what are we seeing? We'll be talking about that later this afternoon. Climate change and sustainability regulations. ESG is very important, and I know all the federally regulated insurers are working through their SCSEs so that we are aware of what's going on with climate. And we are also always concerned with consumer protection and fair treatment of customers, so we'll be discussing some of that today, as well as data privacy, cybersecurity, and looking at technological advancements in insurance. And then lastly, we know that capital is always important and modeling, and these are some of the topics and areas that we can explore. But before we head into the substance of the material, I just wanted to get some housekeeping out of the way. So accreditations. For the lawyers in the room, 210 substantive hours from the Law Societies Ontario and BC, and 210 CLE for the Barreau du Québec. And for anybody who's an intermediary, you get 1 REBO credit for attending today's session. So please make sure that you register and sign up so that we can file these for you. The breakout sessions, you have to again sign up for those, and the breakout sessions will be happening one here and just one floor down, so we can be here to direct you. So the way that this today will go, we are going to have 3 plenary sessions, and we squeezed one in on all of you because we asked our partner from our DC office, Neil, who will be talking about, he's over there in the corner, to talk about the US election and the ramifications for Canada under the new Trump or the renewed Trump regime. Each session can and will host a brief question and answer, and we'll hopefully get to that. So with no further ado, because we want to get to our sessions and talk about the meat, I would like to welcome Jordan Solway and Houston Locate to our speaking panel. Jordan is the legal and investigations, that's not what you are. You lead the legal and enforcement function at FSRA, and Houston is the Executive Vice President of Market Conduct. So thank you both for attending today. Please welcome them to the event. And the one thing I wanted to say before, in the spirit of holiday season that we're just embarking on, in lieu of giving our speakers honorariums, and because they are mainly from the regulator, Denton's is going to be giving a donation to the 2 charities that our group supports, which is Women in Insurance Cancer Crusade and to Project Sunshine. Women in Insurance Cancer Crusade, if anybody in the industry is aware, supports cancer research in Canada. And every dollar given to WIC also goes to cancer research, so there's no admin fees. And the other one is Project Sunshine, and this is a newer charity that we got involved with because of our partner and client NFP who introduced us to them. And it is a very special project whereby we assist when children that are in the Sick Kids Hospital are without their parents, and we help with their activities so that they have something to do when mom and dad isn't around. So we just wanted to make sure that everybody's aware that our guest speakers, we are making a donation on your behalf. Okay, take it away. On to FSRA.
Thanks, Lori, and thank you for having us. We're going to do a bit of a tag team, if I can find my slides here. Wanted to start really with, FSRA is a relatively new regulator. We were started in 2019 after an expert panel that looked at the non-capital markets, financial services in Ontario, and made about 64 recommendations, and basically ultimately said, blow it up and start again. One of the things that we identified at a really early stage in terms of our strategy, you don't think of regulators having strategy, but they do, is being principles based on our approach. And I really want to talk about that in terms of what it means, particularly for the companies we regulate, the individuals we regulate, and the council we work with. We have 5 or 6 different regimes we administer. Houston's got a very busy shop. They do licensing, supervisory, market conduct over a number of sectors. Principles-based regulation at its core is really about working more collaboratively, taking requirements, whether they're in the Act or in the regulations or in our rules, and focusing on the regulatory outcomes. So anybody can read a piece of legislation and tell you what it says. As the regulator, we're interpreting it in a way that focuses on the outcome we want to see, whether it's fair treatment of consumers or transparency or in the case of, we'll talk about this afternoon, take all comers, is timely access to a mandatory product. It's really about making sure the consumer outcome is consistent with what we're trying to do as a regulator. And so the reason why PBR is really important as a strategy for us is that it really requires us to be working with a bit of a partnership with the companies and the individuals we regulate. We want to make sure that we're understanding the challenges of their business. We want to make sure we understand the consumer experience. We want to make sure we understand what the impact is of regulation. If there's a requirement that's resulting in an outcome that's inconsistent with what we're trying to achieve, then we don't want to enforce that requirement. Conversely, if we focus on the principle, things like fairness, things like transparency, things like high standards of business conduct, then it allows us to be more flexible and to look at things and say, well, it's not technical compliance we're looking at, have you achieved the right outcome? And it isn't just, frankly, from a regulator's perspective, often it's about the consumer, and everybody should want the consumer to have the right outcome.
So if I could just jump in for a moment, just to put some numbers to it. Market conduct at FSRA licenses 104,000 companies and individuals. So, and when you look at, let's say, life insurance would cover everything from credit wellness to group to whole life to seg funds, and to expect everything to include a detailed checkbox approach would be one approach, but it would be something that I think would drive everyone crazy, because there would be a need to train and educate, and everyone would just defer to, did you fill out the checkbox? Because there are just so many different myriad products and entities that we work with. So, we've been working together on the policy side with the legal side to make sure we've got a framework that is more proportionate and more scalable in terms of the risks that we have to face.
So one of the things that we did when we started, one of the experiences people had with, particularly with the provincial regulator with auto in Ontario, was the time it took to get rate approval. And so our colleagues who oversaw auto products, one of the first things they did in 2019 was to completely revamp the process. And so it actually resulted in reducing the timeline to get rate approval by 70%. In fact, we were approving rates so quickly for companies that they couldn't actually manage the fact that the regulator was moving so quickly. What this meant was when COVID hit in 2020, you had a sector that was what regulators would call rate redundant, right? People weren't driving, their vehicles were largely sitting. And so what that meant was there was a lot of excess capital in terms of pricing that was sitting, that the sector ultimately returned to many consumers, right, through a variety of means that we had created working in consultation with the Ministry of Finance. However, and the however problem is, or the however is that we did identify in 2020 a problem that had been brought to our attention, which was Ontario, which is the 5th largest auto insurance market in North America, $13 billion in premiums for private passenger, which is the most regulated aspect of auto, over 10 million drivers. People were not being able to timely access a product that's a mandatory product. And what was happening in the market was they weren't getting quotes in a timely way, or they were being put off from getting a quote and having to go to another company to get a quote. And so this was what we call the take all comers requirement, which is a combination of the Insurance Act and regulation. And we had a problem, right? We had a problem in the sense that consumers were not getting access to a product. Companies weren't properly following the rules that they had filed with us. And it was creating a disconnect. So as a principles-based regulator, one of the things we did was we actually took the time to understand the consumer experience. We spoke to people, we spoke to intermediaries, we spoke to agents, we spoke to brokers, we spoke to all the major insurers, the 12 largest insurers in Ontario, and we also ran consumer focus groups. And what we found was there was a problem with the market. Consumers were being not renewed in a timely way. Things were happening like, I'm not going to give you an auto quote unless you buy property, or, we need to, you need to speak to the underwriter personally every Thursday at 5:00 for 2 minutes. You can call them, and that wasn't happening. So things were being done in the marketplace that was really frustrating the ability of a consumer to get a timely quote. So we had a problem, and we had to determine what to do about it. As I said, we did a consultation. We also learned that many intermediaries were experiencing the same problem, and they were frustrated. Brokers have obligations to service clients. They were frustrated with the companies that weren't responding, or they were forcing to move business because they couldn't get a quote in a timely way. And so the problem with this is that, when we raised it, companies would say, well, no one's complaining. Well, someone isn't complaining because it's a hidden harm. A customer doesn't know when they're going online to get a quote, or they're dealing with their broker, if a company isn't providing a timely quote to them, or is putting impediments in that impede their access from getting that information so they can make a buying decision.
Jordan, if I could just provide a little more context. So if someone had come in and said, dear regulator, we would like to segment the population in the following way so that these people pay more and these people pay less, there would be conditions under which we'd have said, no way, you can't do that. That's not fair. And we would have rejected it. But here you had a little industry that had cropped up that would result in that outcome, because they would say, oh, you know what? You're filling out an online form to get a quote. We know exactly where you come from. And no, the regulator hasn't signed off on this, but if we just sort of slow it down a little bit, we know you'll get frustrated. It's 10 o'clock at night. You're in your pajamas at home. You're not going to call anyone at that time. We just will say, you know what, you got to call during business hours, and automatically that business will go down. And so they were doing that. We were seeing something that we would not have approved as rate regulators, but where there had evolved a framework where that activity could still take place.
So what we identified was that consumers in some cases were paying higher premiums unnecessarily. Companies that had filed rates and rules with us weren't honoring those rates and rules. The consumer didn't realize that. So they were being put into a higher product, unbeknownst to them. The other thing we saw was it was not being done. There was discretion that was being exercised in an unfavorable way. It wasn't consistent. Certain consumers were being segregated and others were being given timely quotes. What this ultimately was resulting in, unsurprisingly, is certain carriers were able to push business back in the market they didn't want. Other carriers would pick that up. They would start to experience unfavorable results, and it would become a perpetuating cycle. Ultimately, it impacted consumer choice. It wasted consumer time and resulted in a bad consumer outcome and created a problem for us that we had to fix. And so when I talk about being focused on outcomes, those outcomes are always aligned with specific principles. And what we have in our legislation is what are called statutory objects. And they're high-level outcomes that we look at. There's about 12 of them in total. Some of them are sector-specific and some of them are general. Things like promoting high standards of business conduct, contributing to public confidence in the sectors we regulate, which is a big issue with auto, right? If people don't have confidence in the system, that creates a problem for everybody in the system, including us. And most importantly, as a regulator, we're there to protect the rights and interests of consumers. And so we looked at these objects and we identified that we needed to actually fix what was largely a market problem. And we needed to do so in a way without resorting to individual enforcement action, which we could have have done, because that would have been cumbersome, it would have been timely, and it wouldn't have solved the market problem, which is ensuring consumers had timely access to auto insurance. And so we did a variety of things. The first is we collaborated with Rebo, the broker regulator, who I know is represented in the room. They oversee the distribution of the product through independent brokers. We oversee insurance agents. So we put this on their radar and worked collaboratively with them. The second thing we did, which is very consistent with when you're a principles-based regulator, when Houston and I sort of bang our heads together and say, we think there's a problem here, and we're hearing this, we did what's called a Dear CO letter. So we wrote to the 12 largest auto insurers in Ontario, and we said, this is what we're seeing. We want you to look at your business, and we want you to report back to us whether this is a problem or not. At the time, and perhaps unsurprisingly, not a lot of people responded and said they had a problem. But what was really interesting is that when we had meetings with them individually, they would all tell us the same thing, which is, oh yeah, it's happening in the marketplace, but we're not doing it. Right. And so, Houston and I perhaps are not the most clever people, but when 12 people are telling you the same thing, but telling you that it's not them, you've got a system problem and you've got a market problem that you've got to correct.
Also toss in that those 12 companies represent 95% of market share for Ontario Auto. It's also a collective action problem. If you have filtering going on and quotas and so on, if you are able to actually reduce business for certain less desirable segments, then the best one to play that game is the most profitable, because you are forcing that business into other insurers. And they all actually took the call fairly well, because they were comforted knowing that we called them all, knowing that everyone was getting the same message at approximately the same time, and that the regulator was really seized of this, gave them the reason to go back to their staff and say, listen, the regulator contacted us and the regulator told us that they think everyone's doing it. So please, let's fix it together.
So we also identified that one of the issues was they didn't really understand what the obligation was. So clearly refusing a quote is clear to people. But if it's refusal, if you're obstructing the process such that the consumer doesn't realize that they're effectively been declined, so they're not getting a timely response. And, to Laurie's point about technology and the use of AI, I can take this entire room, you can give your data to an auto insurer, they should be able to spew out a quote in seconds. Right? When you think about the basic information that's required to know whether you fall within their rating requirements, it's very straightforward. What we identified was that filters were being used by aggregators and by some direct writers, so that they were streaming clients. So they may give Houston an immediate quote, but when I went on, I was told I needed to contact them. And when I tried to contact them, it would take days, if not weeks, before I actually got an answer. And sometimes the consumer wasn't getting an answer at all. So what we did was we communicated by issuing what's called guidance. And guidance is basically our way of signaling, this is how we're interpreting the obligations. This is how the regulator is looking at the obligations. And so we looked at our interpretation of the Insurance Act, and we said a refusal to renew also includes basically not renewing in a timely way. If you don't respond in a manner that is consistent with the technology available, that effectively amounts to declining a risk. And you can only do that in accordance with your rules, and your rules have to be approved. So to Houston's point, if you don't want to write a certain segment, you have to be transparent about that. You have to explain to us why you don't want to write the segment, and we determine whether or not that's appropriate. So we also had meetings with the CEOs personally. This was during COVID, so a lot of this was all online, and we explained to them the concern. We told them the outcome we were trying to achieve, and we had them enter into undertakings to use their audit function to actually validate that they were actually achieving those outcomes as we have interpreted it. And invariably, everybody said, oh, we don't think there's a problem here, but we'll do what you're asking. Ultimately, there was a problem. We also did our first, what we call a rule. We have rule-making authority, which is the power to make law. And so we took a regulation and we turned it into a rule. My colleague Jay Harris, who's in the room, actually was responsible for drafting that. And if you look at that rule, which a lot of you probably won't, but if you look at it, it's focused on outcomes. Right? We focus on the outcome rather than a prescriptive requirement. And so if your practices are resulting in a frustration of a consumer's ability to get a timely quote, that amounts to an unfair and deceptive practice. So I'm going to turn this to Houston, because we also had the insurers do their own supervisory review and report back to us. And I think the results were quite alarming.
So
the interesting part through all of this is you had a collective action problem that affected insurers that write 95% of the business in this province. And we wanted to say, we need to fix this. But as Jordan mentioned, for us to take enforcement action on one or two companies, first of all, we were talking about scraping data for thousands, hundreds of thousands of quotes and assembling a case. And then you're taking action on a couple of companies. What about the other 10? And people didn't really understand perhaps their obligations. So how do you solve all of that at once? So Jordan and I sit down, we write the guidance that essentially says that a quote delayed is a quote denied, because that's the world we live in today. You can't expect someone to go online and fill things out and then say, oh yeah, you got to wait. That's the same thing as saying no, because they'll just take the next one, which means it's a higher cost, and an insurer then is getting an advantage that we would not have otherwise approved. At the same time, did we want to be the ones crawling through everyone's data and everyone's algorithms and updating that all the time? Last time we checked, most of these insurance companies are public companies. They all have some sort of compliance oversight function. What can we do to leverage their own compliance such that we actually solve the problem? So what we did was we sent our teams in and we said, please confirm the following. So we sent letters and we said, confirm with us, do you have underwriting rules? How do you use any filtering, or do you use any quotas through your distribution channels? And then report that back to us. And we found that the majority of them had some sort of additional item that they had to attend to. And of course, when the compliance teams come in, there is no policy that says you're going to delay people. There's no policy that says you're not going to give them a quote. The policies say what the policies say, but they had not kept up with technology. They had not kept up with the expectation on the consumer side that you should be able to just get a quote instantaneously. And now that we had clarified our position both with leaders at the firm as well as through guidance, now we had set the foundation for internal compliance groups to take on that work. Not only that, but these firms all have internal audit. So between compliance and internal audit, we asked each company to confirm back to us in writing that they were in compliance. And now what we're doing is on a spot check basis, we're sending teams in to do supervision, where we say, again, selected and based on using a risk-based approach, send us a summary of the internal audit report as it relates to this matter. And if we find that it's perhaps incomplete or certain things were not tested, or that the test period was not enough to provide a robust review, then we'd say, okay, in 6 months' time, please give us the following. And that's the way we've been working with the insurers.
So trying to do so on a cooperative, collaborative basis, we gave them the opportunity to, basically to remediate and validate through their oversight functions, audit, board, compliance. We still had a straggler company that didn't remediate to our satisfaction within the time required. And from our perspective, that creates a market problem, right? When somebody is offside and the others have already done what they're supposed to do, it creates an advantage. And that was part of the problem that we were concerned about initially with Take All Comers, right? If companies are allowed to not follow the rules in a way that pushes business back in the market and someone who is picks it up unnecessarily, that creates a problem. And so enforcement is still very much alive and well within a principles-based approach. We take a measured approach. And if you think about it from our perspective, this is all over a 2-year period, right? When you start, we identify the problem, we're reaching out to people, we're writing Dear CEO letters and saying, hey, there's an issue here. We're doing meetings with CEOs directly. So this is all happening, and we're being very transparent about the problem that we've identified and the outcome we're trying to achieve. And so there's a point at which, as a regulator, where there has to be a real sanction for noncompliance, and that sanction has to be felt by everybody. And this is also a requirement that doesn't just give rise to administrative monetary penalties. We also have what's called quasi-criminal authority over this. This can be a provincial offense in certain circumstances, and that's the last thing any company wants from a reputational risk. The other thing we did is we tried to look at this on a broader way and prepared what's called a thematic review. And a thematic review is really just taking a view at 10,000 feet of what the nature of the issue was, how we approached it, some of the problems we identified through the course of that work, and make recommendations for future consideration. And again, this is done in a very transparent way. We're not doing this, as a confidential report. It's publicized for the sector, for the people who advise the sector, for consumers. But part of what we're trying to do is to make sure that what we're doing from a supervisory and enforcement point of view actually properly informs policy, right? Government policy, if there's need for legislative changes, or we need more expansive authority, or we need to look at whether a requirement is working for consumers, it allows us to reflect on that and to get feedback. I will say that we also reflected about this whole experience. This was our first major initiative as a regulator after launching in 2019. It wasn't something that we even had identified in our business plan priority. We sort of stumbled across it. And what we identified was that it's one thing for us to say we're principles based and you companies and intermediaries need to focus on outcomes. But to Houston's point, that requires a cultural shift. There has to be more trust that the regulator isn't trying to just, do a gotcha to sanction you. They're genuinely concerned about making sure that there's a right outcome for the consumer. And so that becomes very important, because if consumers aren't experiencing the right outcome, they lose confidence in the system. If they lose confidence in the system, that affects everybody, including the regulator. The other thing is that, we really wanted organizations, what we found was at the very top, they thought they were in compliance, but they weren't necessarily understanding and getting the right data to validate whether they're in compliance. And Houston spoke at the beginning about this notion of certification or attestations, which don't do anything. Like somebody, if you're a CEO or you're a senior leader with an organization and you're getting an attestation, I question the value of that unless you have data to validate that your company's achieving the right compliance outcomes. So it requires a different approach, and that's why we have the audit functions come in and actually audit to our outcome standard. One
thing I will just add is that a number of the CEOs remarked to us offline that the approach overall, although, of course, who loves to spend tons of time with regulators, tons and tons of time, said no one ever, but they understood that because we were doing it we were speaking to everyone at the same time, we were being transparent, and we were allowing them to leverage their own compliance and internal audit functions. That was certainly preferred to anything else. And given the size of the auto market, auto's 70% of P&C for Ontario, right? It's a very big piece. And of course, one shouldn't be rewarded just because one finds a way to circumvent the rules. And so a number of CEOs reached out afterwards and said, you know what, if this is going to happen, this was done in a fair way, it was done evenly, and so we understand. And we see that instead of, building up supervisory muscle and sending 10 people in next year, you're saying this is the issue for an insurer to determine. Compliance is part of their job. And now that they know what we mean by that, now they can do it.
And I would say that, when we issue a Dear CEO letter or we issue guidance or do a thematic review, people should have Lori on speed dial, right? They should understand, okay, this is what they're saying. What do I need to do about it, right? Rather than wait in the weeds for something to happen, be proactive, because the best thing you can do, every company, we're not naive to think every company is going to have compliance issues, right? It's how you acknowledge it, you transparently report it and remediate. The regulator's not interested in spending time on companies that are trying to do the right thing and have, whatever problems. We're trying to focus on the 20%, the companies that have no interest in complying. That's what the enforcement and supervisory resources are really intended for. But it's very important to be proactive and to be transparent. And sometimes, and this does happen, Lori will pick up the phone and call, and she doesn't have to name the client, but this is the issue. Can you explain to me what the approach would be? Because I need to give advice and understand what the regulators' temperature on this issue is. So I'm going to turn it over to Houston to talk about fair treatment of customers.
I think this is interesting because this is the auto experience, and it was a major issue because this hurts people who are vulnerable. This circumvents, or Take All Commerce circumvented a regulation, a requirement that was in place. And I'm going to now switch to the life and health side and give you an example that that shares a lot of similarities. an example that has been affected by technology, an example that also has been affected by just consumer expectations. And that is the use of managing general agents in the life and health space. So a number of you, I'm of a certain vintage, and along with a number of you here, and had you gone in to speak to a life insurance agent 20, 30 years ago, then you might have spoken to someone who was driving a company car, who had a company uniform and actually only sold that company's products. And fast forward to today, 70% of life insurance is distributed through managing general agents. And so the portion that's actually, written by someone intermediated by someone who only writes to that one company is a minority, and it's getting smaller. Technology has just changed things in terms of the way that insurance is distributed on the life and health side. So big picture, you've got the insurer, you've got the agent, and then you've got the customer. And so all of us typically deal with an agent of some sort, and agents are licensed by FSRA. So there are 70,000 out of the 104,000 individuals, and companies that are licensed by market conduct are life agents. And what happened over the last number of years is there's this in-between layer called the managing general agent. And over time, companies had seen that it makes sense to get distribution where perhaps there's more choice for customers. There are good reasons for having a managing general agent. They can sell products from multiple companies, and they can help their customers solve problems. However, managing general agent does not actually exist as a separate licensing category, and that has specific obligations under the law. So what happened was you took a product that had previously been distributed by essentially someone who just worked for, fill the name of the company, Candle Life, Sun Life, it doesn't matter, but they only sold products from that company. And of course you have compliance checks, and you have duties that company imposes. And now you had imposed essentially an intermediary where it's potentially the case that the managing general agent had compliance obligations, and they wanted to provide training and screening when they brought in new agents, but none of that had been explicitly set out in the law. So you have an insurance company that, of course, wants to get managing general agents to move product, to help it distribute its business, and to help customers address their life needs, whether it's personal or business or for their family. But then we had said, is there an issue for the regulator to address? And so we initiated a fair treatment of customer review to first of all learn which managing general agents are out there, what are they selling, and what are they doing? And we found out that in some cases, you had some managing general agents that were not performing the training and screening that perhaps is necessary in order to treat customers fairly. So for example, we have authority under UDAP, Unfair Deceptive Acts and Practices, to take action where the training, where materials that are distributed to customers are inadequate or misleading. And so we took some enforcement action on a measured and proportionate basis where we saw that was the case. We also said, what does this actually look like? This isn't just about some theoretical set of training materials. What does this look like from a customer perspective? And so on a risk-based approach, we sampled customer files with some of the agents that worked for these managing general agents where there were issues with the training materials, right? So again, risk-based, right? And we said, this isn't just theory. What does this look like when the customer gets sold the product? And we found some real problems. Again, this is a risk-informed selection, so it's not a random sample. But we had to take regulatory action in some cases, for 50% of the files that we sampled. We found an instance where there was an individual who had purchased, a permanent life insurance policy, and that person's income was like $8,500 annually. That person doesn't need insurance. That person needs a job. And so we said, this is not just theoretical. This is, the materials are deficient, yes, and we'll take some measured action about that. And we got an undertaking, and we did some things. But this actually has to change. And we said, we need to have more done at the infrastructure level. So just like the issue that Jordan opened with Take All Comers and Auto not having kept up with technology and not having kept up with distribution, we had found a situation on the life side where we were seeing the same things manifest themselves, and they were hurting consumers. And so we said, we need to see more done in this space, and we issued consultation materials and so on. But the most recent development, as announced by the province of Ontario in the fall economic statement, is that the province consulted on a licensing framework for managing general agents in the life and health space. So this is their authority. This is their decision. We do not have rulemaking in connection with creating a new licensing class, but the government announced that they would be doing that after following a period of consultation. And of course, those in the room in the life and health space and their advisors would have been aware that's going on. And what will happen over the next little while is, once the government promulgates the legislation and it moves forward, our expectation is that once that goes through, FSRA would have the opportunity to engage in some rulemaking around the obligations of a managing general agent to help fill this void. Because it is only appropriate that once, highly regulated insurers, once their distribution moves to a managing general agent and that intermediate layer, that intermediate layer should also have some obligations. So as an example, everyone knows that it is not appropriate for someone to engage in churning. So I have if I'm an agent and I have all this business with Lori and it's great business, and all of a sudden I say, you know what, I'm going to move from insurer A to insurer B. And now I call up Lori again and I say, listen, have I got a deal for you? They've got a perfect product for you. All I have to do is replace all your policy with this new policy from this new company. And, the premium's around the same and everyone's happy. And of course I pick up another commission. If I'm with a managing general agent, it's quite possible that the new insurer has no idea. How would they know? How would they know? They all they know is they've got a contract with an MGA, and if the MGA is providing that reporting, then they would know. But think of this in real life. You have an MGA that is intentionally and appropriately contracted with multiple insurers, and you've got an agent selling product. As of today, there's no obligation to share that information upstream. And
can I cite one question?
Yeah, sure.
I was going to say, you can outsource your business, right? Which is that is a strategy that a lot of companies do, and it makes sense to Houston's point. But you're not outsourcing the compliance obligation. You're ultimately responsible for it. And so you have to make sure you have a reasonable system of compliance that actually validates and ensures that whatever that MGA is doing, it's in a compliant way. It's ultimately your accountability.
So what will happen is if this all moves forward and we receive the rulemaking and we introduce rules that have some obligations at the managing general agent level, then we will have a framework that is more modern and that has adapted to the realities of distribution today. And customers ultimately, I think, will be better served because they will be able to continue with the choice, but there will be greater accountability on that intermediate level of distribution.
Is that the end of the presentation?
Yep.
Yeah.
I think we can.
So we can go into some questions that we formulated. So when we look at fair treatment of customers, Houston, one of the questions that come up a lot in our practice is, what does fair treatment of customers look like when you're considering a digital distribution option? We always know that the customer journey, the business people want it to go fast and they don't want friction in the digital distribution. They want to ask very few questions, limited information. But how does that work in both, I guess, the life or the P&C space to satisfy the suitability, the needs analysis? Like, what is the tension and what are you looking at for a regulator?
That's a great question because life insurance in particular, it runs the gamut. You can have a 10-year term life policy that someone picks up when they get a mortgage. That is, everyone can see why that person might find it really useful, to someone picking up a 10-year, a permanent whole life policy for $10 million, where it's a combination of life insurance plus a wealth product. What we would do is think of this as being technology neutral. someone could have an agent face-to-face going through a whole series of questions, or it could be digitized. But we would not sort of explicitly prefer one versus another. Right now, as you may know, there is not a specific legal obligation on agents to do a product suitability analysis. There is, as a CLHIA best practice, an expectation that a needs analysis be performed. When we review files, we identify that. If there are no notes, and sometimes they're like that, then we come back and we might write a letter back to the agent saying, listen, it is best practices in accordance with the industry association to do a needs analysis and to do a reasons why letter to explain back to the customer what the result was. We continue to encourage that. I think we don't have a preference as to whether that's a digital experience or a personal experience, but we'd like to see that done. That said, I think that as time passes, I try to look at things as glass half full. Technology will actually improve the customer experience. It'll make it easier for someone to engage in some sort of needs analysis, because for an individual agent to go through a huge questionnaire, it's private. It's painful sometimes to talk about sort of family situations and all your little details. And this will allow people to have a greater deal of comfort in interfacing with their insurer.
I would just add, Laurie, that as you automate your business and the use of AI, that would make a lot of those underwriting decisions as well. You've got to make sure you've got proper governance over your technology, right? And you're looking at outcomes, because there's a lot of models that can spew out, unintentional discrimination, which is still discrimination, right? Based on different class of policyholders who are similarly situated. And so you can't just sort of put it in place and not oversee it. You've got to make sure you're monitoring it.
And we saw that in the auto space with the rating, right? The unintended consequences. Jordan, how the whistleblower program came in, there's been significant enforcement by FSRA. What lessons are we learning? What advice can we give about the recent enforcement?
So whistleblower came in, it's sort of interesting how you get authority. It came in largely because of an experience we had in the credit union sector, where it would have made a difference to have that protection. However, we also found through the Take All Comers experience that there were a lot of people in the system who saw the problems and were afraid to come forward. Whether it was an employee of an insurance company, whether it was a broker who was concerned about losing their contract, everybody, sort of like there's gambling here in this establishment. Everyone's surprised. Everybody knew what was going on. We wanted to create an avenue where people could report to us anonymously and have protection, because as a regulator, you're often arriving at the fire very late. Try to be more proactive. And what we've seen with the whistleblower mechanism is that we've been involved in some very large scale frauds that have been reported to us and allowed us to intervene in a timely way. Having said that, nothing really replaces really good supervision, which is what Houston's team does. Like, supervisors have to be seen, and we need to be focused on even low level stuff. And so my team and Houston's team work together particularly on the licensing side, to deal with important issues of suitability, keeping people out of the system that shouldn't be in the system, because it's a lot harder to remove them once they're in, or to put conditions on licenses if we have concerns. So try to be more proactive. I call it, there's a reference in policing to broken window theory. If you focus on low level stuff and people in the sectors know that you're going to pay attention to it, that actually impedes some of the larger impact stuff. People realize that the regulator is watching. They're not going to turn their cheek, and they're not going to turn their vision on things. They will focus and they will respond. And that's been a big issue for us.
So what's coming? We saw that in November, the MGA legislation came out. Are we going to see something in P&C? Is there anything, other things that are coming at FSRA that the industry can be telegraphing? You can telegraph today for us.
So the Life and Health MGA work started off as a review and a survey, because we want to be evidence-based. And we recently sent out questionnaire nice innocent little questionnaire to 218 insurers, and said, tell us about your distribution practices. We're currently putting together the observations that we uncovered, and we'll be publishing that. I don't know. I gave the approval for it recently. I don't know. It's working its way through
coming.
It's getting translated and it's going to be posted over the next little while. I don't know, 60 days, that kind of thing. It's going to be published, and it outlines the observations. And what we want to do is to really take a moment to pause and then take feedback, because we know that we will not have pointed out everything. We may have missed a few things, and we want to hear back potentially from you and from insurers and from intermediaries on the life and health, on the P&C MGA side of things and outsourcing of insurer functions. Based on input and feedback that we get back, we will then determine what action, if any, would be appropriate. And I think it's fair to say right now that we have not landed on any decisions. We want to be based on evidence, and we want to hear from you before we sort of jump to the next step and say something's needed.
Is there any questions from the audience? I see we're almost out of time here for this session, and you've got Houston and Jordan here.
You can actually ask a question through the whistleblower portal if you want. You can remain anonymous.
Well, then I just have one question. What is your number one best practice that you would give to the industry? I told you guys I was going to ask this one.
So
To ensure compliance with FSRA.
the interesting part about this whole exercise is when you show up at a regulator and you say, okay, what is the job here? Someone will pat the statute, right? The lawyer in the room will pat the law and say, your job is to administer the law. The real job is to make sure customers are treated fairly. And sometimes there are shortcuts. So sometimes it's not, the way to address take-all-comers could have been, let's send out 50 people. We'll send 4 people to each insurer. We'll make sure they're doing exactly what we need them to do. And the shortcut was frankly calling them all up and saying, we think we've got a problem and let's work together.
I would just add that it's not all sort of doom and gloom that regulators are only looking for problems, right? We're also looking for solutions. One of the things our teams did together on is the adjuster licensing when there's a CAT event, right? When there's a large CAT event in Ontario, the most important thing is that those claims be resolved quickly for the consumer. And so a lot of companies that have international affiliates, they want to bring people in. It's very difficult for tax reasons to license them. And so we allow them to do so, providing an undertaking with us. So we're trying to be sort of focused as well on the outcome that benefits. And not all regulation, I know this is going to be shocking to people in the room, not all regulation actually makes sense. And so sometimes the application of our requirement results in a really bad outcome for the consumer. And sometimes we have to, it's not only just enforcing it, sometimes we actually issue no action letters, or we enter into forbearance agreements where the requirement is resulting in a ridiculous outcome and we shouldn't be enforcing it. And so that's called judgment. It also facilitates innovation, right? If people have a business model that makes sense, that's going to result in lower costs, better efficiency for the consumer, but the regulatory framework is creating an impediment. That's a discussion we should have about how we work around it.
Well, thank you very much for coming, guys. Jordan, Houston, it's been wonderful to hear from you. I know that Take All Comers is still, you've made a lot of progress. With the industry, I think there is more balance and fairness, in the past couple of years. We don't see the shenanigans happening with, paper copies and things like that for applications. But there are still some gray areas. So one of the things that, we encourage our clients to is to make sure they view you as the open dialogue, to call you. And to make sure that they have a good understanding of what the regulation is. And I think part of this dialogue and transparency is helping us attend these events. So thank you very much for coming, Jordan.
Yeah, thank you for inviting us.
Thank you.